In this video, I want to give a quick intro to the math behind the quick forecast tool at thelogicaloption.com. There are a few different methods out there that people use for forecasting how much money they will earn from trading if they follow a given strategy for a predetermined period of time. Unfortunately, the vast majority of the spreadsheets and tools that people offer either give an overly optimistic version of reality because they don't incorporate risk, or they're just mathematically incorrect. Our group at The Logical Option has researched the market for what forecast tools and methods are provided for binary options trading, and the most prevalent method used that we have found really fails to incorporate risk. So we are going to cover that method of calculating what is often referred to as expected value, or EV, so that you know what aspects to avoid, and then explain why our alternatives are preferred. To calculate EV, you need to know the probability of winning a trade, which we will refer to as the variable P in this video. We also need the probability of losing a trade, but that of course is just 1 minus P. For example, if I have a 0.7 probability of winning a trade, or a 70% win rate, then I have a 1 minus 0.7 or a 0.3 probability, or a 30% chance of failing. So if I were to calculate the expected value, or EV, of a single trade, it would be the amount I stand to win multiplied by the probability of winning minus the amount I stand to lose times the probability of losing. Just as a foreshadowing of what we are going to warn you about in this video, please note that this comes with some built-in assumptions involved with the overarching assumption that you are only trying to calculate the expected value for a single trade. But before we get into that, let's be a little more specific about how we calculate the win amount and lose amounts of this formula to make it more catered to our application of it. Our win amount will be a percentage of our bankroll at the time of the trade that we will calculate by multiplying the return payout percentage offered by the broker or a contract on Nadex, which we're going to call R, the return payout, multiplied by the percentage of your bankroll that you're staking on the trade, or S. Similarly, the percentage that you stand to lose is calculated by multiplying the loss percentage inflicted by your broker, L, times the percentage of your bankroll that you are staking per trade, S, same S. Since L is very rarely anything other than 1 or 100%, we are just going to assume it is 100% for the rest of this discussion. Notice that S is the same in both the win and loss cases, as I said before. Now we can rewrite the per trade EV formula as R times S times P minus S times 1 minus P, because L times S is just the same as S if L is 1. So remember what we said about the issues that result from the built-in assumption that we are only forecasting the outcome of a single trade? Well, let's look at how this formula is extended to forecast over multiple trades and where that can go terribly wrong. This formula, as we mentioned, calculates the expected percentage growth on your bankroll after one trade. So that means that 1 plus this amount is the expected money multiplier per trade. For example, if the formula says 0.05 or 5%, then the new bankroll that you should expect after one trade is your bankroll amount before the trade times 1.05. Therefore, many people are tempted to reason, if I multiply 1.05 times my initial bankroll 100 times, that is what I should expect to have earned after 100 trades. More generally, they believe that if I multiply my bankroll times 1 plus this EV to the power of n, that is what their expected bankroll will be after n trades. It turns out that the forecast you get by following this method is, in fact, what we refer to as the mathematical expected value. However, the expected value fails to take risk into proper account. Thus, the strategy which gives you the best forecast, if you are using this very common forecasting method, may also be the most risky, resulting in almost certain financial ruin. Let's look at a couple of graphs to better illustrate this fact. We will consider two strategies. The first has a very small risk of ruin, a slightly larger risk of losing some money, and a very high probability of making a decent return after several trades. This strategy yields an expected return marked by the vertical blue line on the graph, labeled E1. The second strategy is much riskier, requiring the trader to stake a higher percentage of their bankroll in every trade, yielding a nearly 100% risk of ruin, with the almost impossible case that they win every time and end up being a multimillionaire. Now, this one case has such a high dollar amount attached to it that even though it is highly unlikely, it still causes the resulting expected return, labeled E2, to be greater than E1. So blindly following an analysis done based on this forecasting method would result in most traders losing all of their invested money. Occasionally in situations like this, I will hear people say things like, "See, you can't trust the math. Sometimes you just have to go with your gut." Now, while I understand the sentiment, it is important to note that the math isn't, quote, getting it wrong, but rather people propagating this forecast method are getting the math wrong. Let's use a specific example to show how the logical options quick forecast method incorporates risk into the output in contrast to the money multiplier forecast method. Suppose we have a 75% payout offered by the broker, a win rate of 67%, and an initial balance of $100. Now, if we increase our stake percentage gradually from 0 to 100% of our bankroll, let's observe how these two methods diverge. In the case of the multiplier, or EV method, we notice that the greater the percentage of our bankroll we stake on each trade, the greater our forecasted return is after 10 trades. With the quick forecast method, however, which, by the way, for any fellow math nerds, is a formula you can come to by applying Bernoulli's proposed wealth utility function to the expected value. For more information on this, check out the St. Petersburg paradox. We may do a video on this in the future if there's enough demand for it, but we'll see. Anyway, we see that while these two are roughly comparable to each other for small stake percentages, they very quickly diverge as the stake percentage grows. Just as you would think, this incorporation of risk and wealth utility tells us that if we risk all our bankroll on every trade, we should expect to lose it all eventually. So if you are looking for what stake percentage will maximize your forecast, you're going to get an answer that is something other than 100%, much less, in fact, of your bankroll, which really shouldn't be all that surprising to you, but now you can get a better idea of what that percentage actually should be. Now, just a side note, I failed to draw my graph to scale since the quick forecast should actually have its peak much lower than 40% risked per trade. The peak of the quick forecast is, in this scenario, actually happens to be much closer to 20%, about 23%. It's important to note that even though the quick forecast incorporates risk in order to give you a much smarter optimal trade ratio, it still doesn't tell you what the risk actually is in a quantitative sense. The risk associated with using the peak of the quick forecast is still too high for most people interested in long-term trading, which is the main reason we offer additional tools for risk management like the simulator and the optimizer. In case you are interested, here is the actual formula for the quick forecast, but please keep in mind that we have made adjustments to accommodate for the broker-imposed maximum trade size. The actual formula used in the quick forecast tool found on our website, in order to be more accurate with broker-based restrictions, has to be a bit more complicated than what you see here. Also, this method cannot account for the minimum trade amount imposed by the broker, so even the version on our website will always be a little bit optimistic, and that's another reason why we provide the more advanced tools to our members, like the simulator, for example. I hope that this has been a helpful video. Please check out the next training video on how to actually use the quick forecast tool, and have a nice day.